The downside Tasuki gap is identified as a bearish continuation pattern within the realm of technical analysis, finding its significance in how it signals the persistence of a downtrend. This pattern emerges over 3 days, beginning with a significant drop in prices marked by a gap. Following this, a small candle appears, not large enough to fill the gap, pointing towards continued seller control. The final day sees prices attempting to rise, but ultimately closing within the gap left on the first day, confirming the bearish trend's continuation. There are variations and patterns similar to the downside Tasuki gap that traders should be aware of to refine their analysis. One notable variation is the upside Tasuki gap, which operates as a mirror image and signals a bullish continuation instead. Other similar bearish continuation patterns include the falling 3 methods and the bearish separating lines. Each of these patterns offers insights into market sentiment and price direction, albeit with different formations and implications. Understanding these variations and similar patterns equips traders with a comprehensive toolkit for market analysis. By distinguishing between these closely related patterns, traders can make more accurate predictions about market movements, enhancing their decision-making process in forecasting future trends. Candlestick patterns are a fundamental aspect of technical analysis, serving as visual representations of price movements within a specific time frame. These patterns are critical for traders and investors as they provide insights into market sentiment and potential changes in direction, including trend reversals and continuations. Among the myriad of patterns, the separating lines stand out for their indication of trend continuation rather than reversal. The separating lines pattern is unique because it specifically signals the persistence of the current market trend. This pattern consists of 2 candlesticks occurring over 2 periods. In a bullish sentiment, the first candlestick is a long black one, denoting a significant sell-off, followed by a long white candlestick that opens at the same price as the previous day but closes higher. This suggests that despite the sell-off, buying interest remains strong, indicating the continuation of an upward trend. Conversely, in a bearish version, a long white candlestick is followed by a long black one, which opens at the same price but closes lower, signaling enduring selling pressure and a continuing downtrend. Understanding the separating lines pattern gives traders and investors valuable insight into market sentiment. It signals that despite fluctuations, the underlying momentum of the current trend is likely to persist, providing a strategic point for market entries or exits based on the continuation of existing trends. This discernment is crucial for making informed decisions in the ever-evolving landscape of the financial markets. The separating lines pattern in technical analysis is a formation that occurs over 2 sessions, featuring candles of opposite colors which share the same opening price but exhibit divergent closing directions. This pattern signals a potential continuation of the prevailing market trend. In a setting where the market is trending upwards, the pattern emerges as a bearish candle succeeded by a bullish candle, both opening at the identical price. The bullish candle closes notably higher, suggesting the trend is likely to continue upward. On the flip side, during a downward trend, the pattern is identified by a bullish candle followed by a bearish one. These two open at the same price, but the bearish candle closes lower, indicating the downtrend may persist. Identifying this pattern provides insight into market sentiment, allowing investors to make informed decisions about their positions. Understanding the separating lines pattern can be a valuable tool for those looking to gauge the momentum and direction of market trends. Separating lines in the context of technical analysis are unique patterns that occur on candlestick charts. These patterns provide valuable insights into market sentiment, showing how even a temporary move against the prevailing trend is quickly countered, reinforcing the original trend's direction. Let us explore how separating lines reflect underlying market sentiment and suggest strong underlying momentum favoring the original trend. The separating lines pattern consists of two candlesticks. On the first day, we observe a candlestick that moves in the opposite direction of the current trend. This could momentarily suggest a shift in market sentiment or a potential reversal. However, the appearance of the second candlestick is what makes this pattern significant. This candle opens at the same price as the first candle, but then moves firmly in the direction of the prevailing trend. This immediate return to the trend's direction is a strong indicator of the market's underlying momentum and confidence in the ongoing trend. What makes separating lines a powerful signal of market sentiment is the clarity with which it showcases traders' commitment to the trend. Despite any short-term fluctuations or apparent moves against the trend, the swift return to trend direction with the second candle highlights a robust inclination towards the original trend. This reinforces the idea that the temporary move against the trend was merely a blip, and that the underlying sentiment and momentum are decidedly in favor of continuing along the established path. In essence, when investors see a separating lines pattern emerge, they can interpret it as a strong signal that the market's underlying momentum supports the prevailing trend. This pattern reassures investors that despite any temporary deviations, the conviction in the trend's direction remains unshaken, suggesting that the trend is likely to persist. Separating lines are recognized as a continuation pattern in technical analysis. This pattern plays a crucial role by reinforcing the likelihood that the existing trend, whether it is bullish or bearish, is likely to persist. To understand how separating lines function, let's first visualize two candles on a chart representing trading activity over 2 days. In a bullish trend, the first candle is bearish, closing lower than it opened, while the second candle is bullish, opening at the same price as the first one did but closing higher. The key characteristic is the opening price of the second day's candle, which is the same as the first day's opening price, hence the name separating lines. This pattern indicates that despite a day of pullback, the bullish sentiment regains strength, suggesting that the trend will continue upward. The same applies in a bearish trend, but with the roles of the candles reversed. The bearish separating lines pattern indicates that the selling pressure remains strong, pointing toward a continuation of the downtrend. This pattern helps investors to make informed decisions by suggesting that the current trend is likely to continue, assisting in strategy development for those looking to capitalize on the ongoing direction of the market movement. In the context of trend continuation signals in technical analysis, volume plays a crucial role as a confirmation factor. Ideally, when a continuation signal appears, it is more reliable if the volume on the day of the second candle is higher than on the previous day. This increased volume supports the signal by demonstrating that a greater number of traders are participating in the movement, thereby adding credibility to the belief that the trend will continue. Additionally, other indicators such as follow-through candles moving in the direction of the trend can further confirm the likelihood of continuation. Technical indicators such as moving averages or momentum oscillators that align with the direction of the trend also play a significant role in strengthening the continuation signal. When these factors align, increased volume, follow-through candles, and supportive technical indicators, they collectively offer a strong case for the trend's potential to persist. By understanding and monitoring these key confirmation factors, investors can make more informed decisions regarding their positions in the market, enhancing their opportunity for successful investments. Separating lines in technical analysis are candlestick patterns that provide a strong indication of trend continuation. These patterns occur when the candlesticks demonstrate a clear separation, signifying that the current trend is likely to continue. However, while separating lines offer valuable insights into market movements, their predictive power is not absolute. To enhance the reliability of predictions based on separating lines, it is advisable to use them in conjunction with other technical analysis tools and indicators. For instance, trend lines can help confirm the direction of the market trend, while the Relative Strength Index, or RSI, provides insights into whether an asset is overbought or oversold, potentially indicating a reversal or continued strength in the trend. Similarly, the Moving Average Convergence Divergence, or MACD, helps identify momentum shifts, further validating the trend continuity suggested by the separating lines. In summary, while separating lines are a potent tool for predicting market continuation trends, combining them with other technical indicators like trend lines, RSI, and MACD maximizes their effectiveness. This multi-tool approach allows for a more comprehensive analysis, enhancing the overall accuracy of market movement predictions. To enhance market analysis using the separating lines alongside other technical analysis tools, one can combine various methods to obtain a multifaceted view of market conditions. For instance, trend lines can be utilized to confirm the direction of the trend highlighted by the separating lines. By drawing a line that connects two or more price points on the chart, one can visually confirm whether the market is moving in an upward or downward trend. Moreover, incorporating the Relative Strength Index, or RSI, allows an analyst to gauge whether an asset is potentially overbought or oversold. The RSI is a momentum oscillator that measures the speed and change of price movements on a scale of 0 to 100. Values above 70 indicate an overbought condition, suggesting a potential reversal, while values below 30 suggest an oversold condition. Additionally, the Moving Average Convergence Divergence, commonly known as MACD, can be employed to confirm the momentum direction indicated by the separating lines. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. A positive MACD indicates that the short-term average is above the long-term average, signifying upward momentum. Conversely, a negative MACD suggests the short-term average is below the long-term average, indicating downward momentum. By combining the insights gained from the separating lines, trend lines, RSI, and MACD, analysts can form a comprehensive understanding of the market's current state. This integrated approach allows for the identification of consistent trends and potential reversal points, aiding in more informed decision-making. When discussing the concept of separating lines in technical analysis, which indicates a continuation of trend, it is important to recognize and avoid common pitfalls. One major error is misidentifying the pattern because the opening prices seem similar but are actually not identical. This minor discrepancy can significantly affect the analysis and lead to incorrect conclusions about market movements. Additionally, acting on the separating lines pattern without waiting for additional confirmation signals is another common mistake that leads to premature trading decisions. Relying solely on this pattern for making investment decisions can be risky. It is essential to seek further evidence and signals that reaffirm the trend's continuation before committing to a trade. This approach helps in making more informed and less risky trading decisions. Understanding these nuances is crucial for effective market analysis and avoiding common errors that could lead to unfavorable trading outcomes. In the context of trading strategies that focus on the separating lines candlestick pattern, it is crucial to identify and act upon patterns that indicate a continuation of the trend. The separating lines pattern, characterized by two candlesticks opening at the same level but closing differently, can serve as a reliable signal for traders. When utilizing separating lines in trading decisions, an effective strategy involves entering a trade shortly after the pattern is confirmed, ensuring the trend direction aligns with the pattern's implication. For instance, if the separating lines suggest a bullish continuation, a trader might consider entering a buy position shortly after the pattern's confirmation. Setting exit points is a strategic part of leveraging the separating lines pattern. Exit points can be determined based on the strength of the prevailing trend, anticipated resistance or support levels, or a predefined risk-reward ratio that aligns with the trader's risk management strategy. If the trend demonstrates strong momentum, a trader may set an exit point at a higher resistance level, anticipating further price movement in the trend's direction. Conversely, if the trend appears weaker, setting a closer exit point may help in capturing gains before a potential reversal. Incorporating stop-loss orders is an integral aspect of managing risk effectively when trading with the separating lines pattern. A stop-loss order can be placed just below a recent swing low in a bullish scenario or above a swing high in a bearish scenario. This approach helps in limiting potential losses if the market moves against the trader's position. The use of stop losses ensures that traders can protect their capital while pursuing opportunities highlighted by the separating lines pattern. In summary, the strategic use of separating lines in trading involves timely entry into the market post-pattern confirmation, setting informed exit points based on trend strength and anticipated price levels, and employing stop-loss orders to manage risks effectively. By carefully applying these strategies, traders can capitalize on the insights provided by the separating lines pattern while safeguarding their investments against unforeseen market movements.